Hello and welcome to Investing Confidential. A lot of economic data has been coming out this week, especially, last few days. You had unemployment, today you had GDP, durable goods. The market celebrated. Okay. The market was, didn't want to go down. And the numbers look good. Looks like the economy's strong, et cetera, et cetera. Why did this happen? I'm going to tell you why it happened. I'm going to also show you why the market is completely wrong, absolutely wrong, and stay tuned. And I'm going to show you why not only should you not be excited, you should be worried. All right, let's start with GDP. You had 2.9% versus 2.6%, so the economy was stronger than expected. When you dive between the numbers, the economy was strong, but it really, there were a lot of things like energy and other things that skewed the numbers. So at the end of the day, you had, we've been exporting a lot. We're sending a lot of energy overseas and all that kind of stuff. But in the end of the day, this is not what the Fed wants, okay? Because what it's really about here, folks, is the Fed. Okay, the Fed has been raising rates. We tell you, don't fight the Fed, and all these numbers. Don't get excited because the Fed is going to be tough now. They don't want a hot economy. They don't want to keep raising rates, but they have no choice. Okay, let's look. You had jobless claims again lower. As I said, I don't think these numbers are accurate, but this is what the Fed looks at, and they don't like they don't like low unemployment. They want to see higher unemployment. They want to see the economy cool down. Then you had durable goods. Okay, was up strong. Look, this is good for the economy, I guess. Most economists rely on this type of data, durable goods, and obviously the stock market has been reacting, but it's not good. Okay, again, strong economy means the Fed keeps going because what this means, folks, is that inflation is going to keep sticky and keep going higher. Actually, you could see a reversal in inflation. I spoke about a few months ago inflation was coming down, which we were right on. But all this points to actually inflation ticking up, which is going to be a disaster. Okay. Then you've got wages. Okay. Wages are breaking to the upside, as you can see here. It's necessary, as we spoke about. I mean, you can't, some of these industries like hospitality, which I'm going to talk about in the future, I mean, you can't make a living wage working in hospitality. They don't pay anything. And so wages have to go higher. It's necessary, but again, it's inflationary. The Fed doesn't like this. They don't like hot economies. They don't like rising wages. All this means inflation is sticky. That means we're going to get at 25 for sure. There's talk of 50, but I doubt it. But the Fed's going to be hawkish, okay? 25 for longer. We're going to see 25, 25, 20. The Fed's not going to stop. Remember, we talked about this. The real interest rates are still very negative, and the Fed will not stop until we get at least neutral rates. So that means we're going up the terminal rate. We're going to hear this again. We're going to go above 6%, maybe even 7%. That's the only way to stop this economy. Okay. And so what we have here is a classic bear market rally. We're seeing this now. When is it going to end? I have no idea, but it is a bear market rally because the numbers are a lot worse than what we're seeing. And let me look. Let me show you why you should be cautious. Okay, first look at gasoline. Okay, gasoline is going up. Crude oil is going up. We have obviously we have inventory issues, low inventories. We've got demand picking up with this China reopening. This is temporary, but again, it's giving again, this is, we talked about the rotation of commodities. Inflation is going to be sticky. We got the jobs. Okay. Layoffs are accelerating in technology. Okay. As you can see here, layoffs are accelerating, but it's all industries as well. Okay. We're going to see, massive amounts of layoffs in other industries. It's continuing. It's not going to end. And I think the layoffs, as you can see, are just the beginning. We're just seeing this tick up, and it's going to continue. Okay. Why? Demand is shrinking. Okay. For these tech companies, especially, they built up for this. They thought the COVID demand would be there forever, which is stupid, but they did it. And now you're seeing massive layoffs because not only is the COVID demand not there anymore, it's going to go below pandemic levels. And that's really bad. And here's a more alarming statistic. Business closings, as you can see here, at an alarming rate. Okay, this is not good. This is mainly small business, which is, we spoke about, the engine of growth for employment. All of this we're going to see unemployment skyrocket, folks, at some point when they stop manipulating the numbers. We're going to see it. Okay, another indicator, look at this. Dry bulk shipping rates. Okay, dry bulk is, heavy industry, iron, all this kind of stuff, iron ore, etc., down 90%. Okay, sink that in. 90% shipping rates. That means there's no economic activity for large industry moving around the world. I mean, this is not good. Okay, I don't care what anybody says. These chickens are gonna go home to roost real fast. And then you've got more really bad housing data. Existing home sales at multi-decade lows. The US economy and housing are tied. They're linked. They've been linked forever. Okay. So again, this is showing that the economy is in really bad shape. And then, is it going to change? No, because look at housing affordability. Okay. This is just going to accelerate things to the downside. Your homes, housing is in for a multi-year drought. Okay, we're going to see it continue to be down because affordability is terrible. There's no buyers. There's mortgage rates are high, and it's a disaster. So, bear market rally. Here's an indicator. This is something to watch. The markets, the S&P can't close above the 200-day moving average more than a day or two, and it goes right back down again. This trend is bad, but it's certainly, we have to watch for either an extended bear market rally or reversal. But if this continues, okay, we're going to see continued movement lower, as what I think it's going to be. So again, a lot of good data, but good data is not good. Okay, good data is not good because the Fed will continue to raise rates and pummel the economy. That's their objective. So for you investors, be careful out there.